You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome to the show, Danielle, and best of the season.
Thank you, Jim. Same to you.
We'd like to talk about something a recent survey just found out that 82% of young Canadians say they have no idea on how to invest and look after their finances. Do you find that shocking?
No, actually, I would imagine that the number is even higher than that. I would suggest that the number of people, never mind in that age group, but much older, who have no idea how to invest would be the vast majority. I would say probably 95% of the population. When it comes to talking about, security markets, publicly traded markets, that sort of thing, I would suggest that most people have no concept or terms of reference even for knowing what to look for or how to go about it in a risk-controlled way. And, Lord knows the money business doesn't want them to have any meaningful education, because if they're, out of it and sort of gullible, they're much easier fish to fry, let's put it that way. So there's not much legitimate effort to even inform people of facts when it comes to things to do with their money, or how much to put into things, or what to do in terms of, for example, paying off debt first. And in fact, the money business goes around holding seminars and running ads and things, telling people to borrow money to invest, right? So they have just the worst possible advice available, and yet those are the ones who are usually tapped as the quote experts to inform a public. So it's a very dangerous area for most people, and when they have some money to lose, that's usually when they learn it the hard way.
The Bank of Canada has mentioned perhaps bringing in negative interest rates. Is that going to really throw a wrench into things if they actually do that?
Actually, I was looking at that commentary coming out of the Bank of Canada. That was Mr. Pelot's just mentioning, as they all do, all the bankers, central bankers of the world, being at the zero bound, being already at virtually zero, and really having very little in terms of the conventional policy tools for monetary policy. They've all continued to jawbone and say, don't worry, we've got lots of other options, we've got lots of other tricks up our sleeve. It's mostly jawboning and very little actual merit to what they're saying. What they were, they're basically trying to say, don't worry, we can go way past zero if we need to. All they're ever talking about, Jim, is the policy rates that they control in the very short run up front. They have really no influence on what happens in the publicly traded markets and what the longer end of the curve does. That's all dictated by people making assessments of the economic strength or not of the economy. And for that reason, those longer term rates have been quite low for a long time, because the growth has been so slow everywhere. So the fact that the Bank of Canada says that, don't worry, we could go negative if we had to, is not necessarily what they will do in their policy rates. It's certainly a nightmare scenario for pensions, for insurance companies, for savers, for even balance sheets of governments themselves. It's not what anybody would want to do, but I guess it's when you're desperate. And the Bank of Canada has been increasingly sounding more desperate as oil has now plunged back to the 2009 lows, right?
Well, I just saw an article saying they expected 2% growth in Canada next year, and that they're not really worried that we'll be in a position that they'll have to use negative interest rates. But again, so many of these government forecasts have been wildly inaccurate, and they're always overly optimistic.
Oh, you're absolutely right. And they never forecast a recession. They are literally, I think, brainwashed out of the possibility of even acknowledging a recession as part of their job description when they're indoctrinated into the school of monetary thought. And their growth forecasts, they have all of the central banks of the world in the major developed markets have all forecasted or targeted this elusive 2% growth rate. In reality, the growth over the last 15 years as we've worked through this secular bear environment has been half of historic norms. So, they were a historic growth rate typically may have been in the 3 to 4% range. In fact, was in the last 15 years, we've not even averaged 2. So they are inherently unequipped and they've had no training for the kind of terrain that we find ourselves in today. The classic studies, classic training of economists and financial types is all in this assumption of a steadily increasing inflation rate, steadily increasing asset prices, rising dividends, rising earnings growth. This is all what the textbooks teach them. This is exactly the opposite of the conditions that we find ourselves in. We have actually negative earnings growth today in the world. We have demand falling, still not yet finding a bottom here. And we have a very disappointment to their inflation forecast because of the aging demographics, because of the overcapacity in the world, and because of the debt weight. So all of that is really foiling all their best made plans, and they find themselves really with nothing further to offer except more of the same, which is to say, we've been cutting rates since 1982, and we can do it further, even though in all sense of common sense, that we're already at the zero bound.
One of the problems Canadians have, of course, is trying to save. If they have negative interest rates, if you put 10 grand into some kind of saving instrument, you get less when you go and cash it in. Why would anybody buy a bond in the first place in that kind of a climate?
Well, see, there's a lot of things that people don't appreciate about, because again, if you haven't had any experience, and we really haven't seen conditions like this since the 1930s, and very few people alive today remember that period. But what happens is that people were undersaved in the past 15 years, and now they're realizing that as they've got older and they have so much debt to carry. So they're having to try and, put away money and turn to their savings and say, well, what income can I take off that now that I'm not working as much, and that sort of thing. And that's when they appreciate that the same cutting of rates, which helped spur the ability to consume as rates fell over the last 15 years, now is doing the exact opposite. And so where it was the wind at the back of consumption for a number of years, it's now a huge headwind. And that's because, in an aging population, the people who are looking to their savings are finding they have a fraction of the income they used to have. And that's really curtailing consumption in the older age demographic. At the same time, the people that are younger already have so much debt that they really can't meaningfully add to that debt to increase their consumption at this point. So you've really got this flat demand picture everywhere, and for the same reasons, really. So why people buy negative yielding bonds, for example, in countries like Germany, the reason that capital has still flowed there is because they're concerned about the creditor issue, right? They're concerned about which economy or country is going to be able to keep paying its debts in this very difficult global environment. And so the vote was always to who's got the stronger balance sheet. So you see funds flowing into the German bond market, for example, just because people are so concerned, Jim, about security of principal, period, about getting their principal back. And that's a totally different dynamic than, people wanting to, push to get higher and higher income levels off their capital. So, right now, our thesis for the last couple of years has been that North American interest rates were relatively high relative to the rest of the world, and that was likely to mean that it would attract capital as money flowed back to the U.S. dollar, as an example, and as money was flowing into Canada there for a while when our dollar was high and stable. We had a great allure to international capital, so they would come to our currency, then they would look and say, hey, let's put money in, the balance sheet of these countries, especially as the euro weakened, the Japanese yen looked rough, the alternatives in the world were not great. So people came to the North American bond market and continue to do so today. So that's, likely to drive rates lower as we go forward here, because the repatriation of money from emerging markets is not finished yet. We've had this huge bubble in emerging market debt and equities, and a lot of that money was borrowed in U.S. dollars. So as that has to get paid back, they come back and have to buy U.S. dollars to pay off their debts, and the money moves back out of those emerging securities and markets back into North America. Now, what's happening in Canada, very interestingly, for a long time we too were a benefactor of that international flow, that vote of confidence. They said we're leaving some of these areas that seem to be having perennial problems and coming to what was perceived to be a more stable marketplace in Canada. But with the implosion of commodities since 2011 and our Canadian dollar losing value steadily and really rapidly over the last year, what happens is capital starts leaving the currency, because international capital is saying, geez, we were looking for a safe place to park and we're down 35% on the currency. So when they start selling your currency, they start selling your securities. So we've seen that in the corporate debt market, where prices have been coming off rapidly. We've seen that in our stock market, Jim. If you'll notice, the stock market has fallen precipitously again. We're back to where we were in 2006. We're seeing, to a much lesser extent, capital coming out of our highest grade investment bonds. And I think that again goes back to, provinces, some of our larger municipalities, and the federal government is still relatively less levered than some of these other jurisdictions. So that is keeping some capital, and the rates relatively higher than people can get for that highest grade investment credit all over the world, is keeping a certain amount of funds still in Canada in the highest end of the bond market, but everything else is really seeing an exodus.
We'll have more with Danielle Park right after the break.
See singing impressionist André-Philippe Gagnon.
And I think to myself,
In Oliver, December 29th. In Kelowna, December 30th. Buy online and save at ontourtickets.com. Unbelievable harmonies, spectacular performance, the ultimate tribute to the Everly Brothers and Simon & Garfunkel. Bird Dog and the Vintage Electric Band, Saturday, January 9th at the Alex Goulden Hall. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Danielle Park. Danielle, how do we explain Toronto's and Vancouver's high real estate prices and the fact that Toronto went up something like 15% this past year, Vancouver 17%, and they're saying we can expect another 5 to 7% more for real estate prices next year?
Yeah, well, you have to always be mindful that this has been an incredibly long real estate cycle this time. It's been extended by the falling rate environment that, as I say, started in 1982, but really accelerated over the last 15 years. And that, as well as a reduction in lending standards and an increase in CMHC funding that was available for backing in the mortgage market. So those factors have driven Canadian real estate up for a very long period here, coupled with, as I said, that attraction of international capital who is fleeing other areas, China being one of them, where there's been great instability. In the past few years in particular, that money was flowing into Canada and looking for places to park. And so that really has been a huge support to our realty markets. Now, I caution you that just like we said with economists and central bankers never seeing a recession, realtors and realty groups that do these forecasts never ever see a downturn in real estate, right? So you can't expect them to offer much guidance when it comes to the risk to the downside. They'll always sort of give you a rosy forecast and anticipate higher prices. But one of these days, that can't be right, because housing has to correct from when it becomes overvalued, just like stocks, just like commodities, just like everything else, when it becomes too expensive for the masses to purchase and credit is no longer readily available, or they can't take on more credit because they're already full of credit. All those factors tend to slow. Now, what you're seeing in most of the cities and areas in the country is that is in fact happening. Like prior hot markets, that we know in Alberta. A couple of years ago, you and I were talking about Calgary, Edmonton, Alberta was on fire. You're seeing a much slower, weaker housing market in many of those commodity-centric centers. So now we're working back to, we've got the west coast of Canada and Toronto, which is the key banking sector, right? And also a main attraction to international capital. So that those sort of hot areas have held up relatively longer than some of the more commodity-centric areas. But I think that it would be wrong to assume that that's a permanently new high plateau as well. So I've always been sort of concerned about how long this is going on, because the debt numbers continue to escalate, and that means it's inherently weaker. I think as well, when you're seeing a further decline in China and some of these other areas in terms of everything, in terms of the economy, a full-on credit crisis seems to be unfolding in places like China at the moment, you could very easily see repatriation of money having to flow back out of, or trying to flow back out of Canadian realty markets in some of these hot spots, take their cash back home and pay off bills, or, finance businesses that are in trouble and that sort of thing. And that might be a problem, because it's a question of, once everybody's bought, once everybody's in, once everybody's booked their notional gains in their head and assumed it's, cash in the bank, kind of savings in their pocket, the problem becomes how liquid is that market when prices are really, really high and so few people have yet to get in or can afford it. I mean, just the home ownership rate alone in Canada has gone to something like 69% recently. That's historically about 5% above the norm. And when we've seen that in other countries, like the United States, for example, that was the peak of the housing market, and then 5% was the normal retrenchment after that, as a certain part of the people lost their homes to foreclosure or, had to go back to renting, that kind of thing. So that 5% move back can have a dramatic impact on prices. In the United States, went from about 69 to 64% home ownership rate today, and yet during that time, home prices fell up to 60% in some areas. So people may say, well, so what if only 5% of the people are in homes they can't afford and will end up losing them? That's no big deal. The problem is when they go to sell, when people are looking to raise cash in these times of financial crunch, there's not enough people to take all these high-end properties, and so price begins to fall. So I think as long as nobody's ever looking for liquidity or a reason to take money out of these markets, you could see them hold up, but that's just not the way the world works. People have to raise cash at some point, downsize, even if it's just from aging. An aging person will say, well, I no longer want to keep a ski chalet, a cottage, and a mansion. It's way too much realty. Just demographics alone, they're going to look for a way to downsize and liquidate and get some cash out of those markets. And that's when the problem's going to really come to the fore, because, as I say, who will buy is the question.
And also a problem that's cropped up in Burnaby is all these affordable 3-story walk-up apartments are being raised, and they're putting in luxury high-rise condos, so lower-income people don't have a place to live anymore.
Actually, middle-income people are having a hard time finding places to live. There was a study out of the United States this week. It showed that the middle class is now smaller than the elite class and the poor class, as these divisions go, added together outnumber the middle class. And that's the first time that's been the case in a long, long time. The strength of North America has typically been in the size and ability of our middle class of people to, quote, to not only just consume, but to pay taxes. So now that you have this great polarity between the uber rich, the 0.1%, and a bunch of people who have fallen out of the middle class in the past few years with stagnant wage growth and high debt levels, you really have this shrinking body of people in the middle, and that's a problem for move-up markets. That's a problem for everything, for revenues, for taxes, for it becomes a hollowing out of the economy in general. So, I think we're going to see more fragility because of that. As you have these, as I say, the uber rich, which can only spend so much of the money that they have, and then they just really stockpile it, and then everybody else who can't really make ends meet well.
And finally, Danielle, you said the secret to a happy holiday is to eat and spend less.
Yeah, that was a study, but it's not, I put that kind of stuff up all the time, Jim, as you know, but, this whole obsession with consumption of all things that are actually destructive in the end, and that goes for, consumer goods ad nauseum, and it goes for eating out or eating too much food. It's not a good exchange of your energy. If you're working hard to get a few dollars and then you're using it in self-destructive manner, like destroying your health or destroying your household balance sheet. So I think it's a good reminder going into the holidays that true happiness doesn't come from, indulging excesses to self-destruction, but by being a little more thoughtful and having a bit of peace and health in the process.
Well, the fact that Christmas ads have been on since September, it looks like the retail business certainly doesn't believe in that.
Yeah, and I think that the retail is in a major downsizing, as we've talked before. This holiday season's been weak across the board, and I think people are really coming to their senses, both out of necessity, as I say, because they've run out of lines of credit, but also out of a sort of a sentiment shift. The young people are seeing that that's a kind of path to nowhere, to just mindlessly consume stuff. And I think they're getting much more focused on, quality of life and trying to have some savings and some peace and that sort of thing, and get out of debt. I think that's a generational shift that's playing out right now. So there's going to continue to be consolidation. I think the retail sector, you're going to see probably 2/3 to 3/4 of that over the next perhaps 5 to 10 years, just having to disappear. Just way overbuilt on the credit bubble, and just no way that everyone needs that many specialty stores. I think we'll see a reconsolidation back to, department stores and online retail, but not so much to these massive specialty bricks and mortar stores, that sort of thing. So anyway, it's a trend that's now in reverse. I think it'll be much healthier, and it's showing up already this Christmas season.
Well, I'm trying to convince the family that we should have alternating Christmases. One year, okay, buy whatever you want for people. The next year, a small Christmas, small gifts to give us at least a chance to recover for 1 year.
Absolutely. Or, pick names out of a hat and designate one person to get a gift that year, stuff like that. All sorts of smart things. And a lot more interest in experiential things rather than purchasing things. I think time together, recreational things that people are interested in now much more than they have been in the past.
The city of Vancouver is running ads encouraging people to get gifts for each other that don't involve physical products. So perhaps concert tickets, things like that, where you're not throwing more things into the garbage after Christmas.
Yeah, well, I think this year the climate change talks in Paris, I think probably with the terrorist commotion there in advance of the event, and then that coming right after, the profile of Justin Trudeau going to the talks this year, the brand new government for Canada, I think it's really focused people on the whole environmental issue and how we must reduce consumption and be more thoughtful in the way that we are disposing of all sorts of things. And yeah, I think it's having an effect. And again, the new generation, the younger generation, the 25 to 45-year-old age group are all very concerned about the environmental stuff, and they are aware, and they are speaking out, and they are lobbying their governments. And I think that, again, as I say, that's typical of a younger demographic, but particularly right now, I think there's a sea change going on in the world, and so all of those topics make sense within that context.
People are talking about the jobs lost in the oil patch, but if fossil fuels fall out of favor, why do we have to stick with oil as a generator of jobs? Aren't there other areas we can look at?
Oh yeah, and there's lots of really exciting stuff coming out. I write about it. I put articles and clips on the blog constantly. I think we're at the start of a mammoth shift in consciousness and choice, and it's a really exciting time, really. It's not just one thing. It's not just air quality that people are talking about. It's not just water. It's not just physical health. It's not just food supply. It's everything. And so you're seeing that crop up in policy decisions and in choices. One of the things that you notice coming out of Paris is there's no global agreement per se on carbon tax, as an example, even though everybody's saying that that's the right way. Business, oil companies, everyone. Alberta's introduced their version of a carbon tax. Everybody agrees that makes sense in a capitalist society. Put a price on something you want people to be accountable for, and it'll work. But they can't come to a global agreement on that, But what you're seeing is this going back to sort of the core of everything, right from the family and the community, the city, states, provinces. Everyone is saying, okay, well, if we can't agree on, in terms of a multinational agreement of all these countries, surely we can do things smarter from the ground up. And the mayors of the world are taking on this 100% renewable initiative, signing on to it. 100 Canadian cities have signed on to this, the Blue Dot program, which is acknowledging the right to a healthy environment as part of the rights of their citizens. So again, a lot of grassroots stuff, and that Stanford professor who started 100%.org, that's a group of engineers that have literally done the math and laid out the blueprints for these cities, saying, you know what, here's how you transform yourself to renewable energy, 100% renewable energy. Here's the massive health benefit, savings to the healthcare system, savings to water management, savings to, all these things. Here's the math of it. Here's the investment, which would be paid back within 15 years. And pointing out, hey, you're all looking for job initiatives and ways to stimulate, wage employment and that sort of thing. This is the no-brainer way to do it. So, as I say, it's a very exciting time.
Danielle, thank you very much for chatting with us.
Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council, Incorporated. You're listening to HowStreet.com Radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward comments about the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com Radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com Radio is a production of HowStreet Media Incorporated.